The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day, how you going? Phil Tarrant, host, Smart Property Investment Show. I hope you're well. We're all across rapid changes as Australia accelerates out of COVID-19. Most recently, announcements of international borders opening, at least for New South Wales, at least other states soon to follow, to get residents home, families, residents or citizens home, and then extrapolating out into what that looks like for powering migration moving forward. Interesting times to be in property in Australia. We've got it cracked and covered on smartpropertyinvestment.com.au. What I'm getting now is a lot of questions from our listeners wanting to do some deep dives into a number of different markets, which will be the beneficiaries or impacted by these changing dynamics. We all know just how hot this market is running right now as we run up until Christmas. There's a lot of people out there looking to buy property, really strong family balance sheets at the moment. Australians probably in a better position than ever before to borrow money, or at least in the eyes of the banks, irrespective of limitations to borrowing with those recent APRA requirements. But we're going to be covering this. There's going to be a theme over the next couple of months as Australia projects itself out of COVID-19. It has been accelerated by this new Premier arriving in New South Wales. He's been in the seat now for a couple of weeks. He's taken the bull by the horns and he's moving pretty forward. I think he even got a bit of a nudge from the Prime Minister saying, mate, just slow down a bit. We've got to sort this out a little bit more, but I like your intent, but let's just get a bit coordinated. But this is all going on right now. However, there is certain states which are still coming to terms with framing their relationship with what COVID looks like as something that they need to live with moving forward. Most recently, the Queensland Premier's come out, or the health professional is saying, hey, look, they've changed their rhetoric. We've got to start thinking about how we're going to approach this. Shouldn't really be focused on case numbers. It should be around hospitalisation. Hey, let's all sort of get together and start working it out. They've now decided to open up the borders in Queensland for the rest of Australia, at least New South Wales, for Chrissy. So obviously looking for the tourism dollar. We'll do a deep dive into Brizzy in time. And you've got to sort of apply that also with announcement of the Olympics up there in a period of time. So that's a market in itself. New South Wales will cover that in time as well. But today I wanted to dig down into the Melbourne market, and Melbourne, the most lockdown place in the world as a result of COVID-19. Depends whether you love him or loathe him. Some people call him Chairman Dan. Someone call him the saviour that is Victoria as a result of COVID-19 and how it's projected through it. Still in lockdown, about to merge out of it with some restrictions still in place. Case numbers are highest it's ever seen, up over a couple of thousand, a couple of days in a row, more than the original lockdown. So they've done it tough, done it harder than most. And this is going to play out over time. But what does this all mean for property markets? We've got our East Coast team together right now. Someone that is locked up, Cam McKellen, Director, Open Corp. We're joined by Matthew Lewison. He's also Director at Open Corp. He's based up in Brizzy. Myself, I am in Sydney. Matt's the sort of brains trust when it comes to the numbers, the nerdy side of things when it comes to Open Corp, whereas Cam's the guy that's been steering the narrative and giving interpretation of it for many years. Gentlemen, how are you going?
Very well, Phil. Good to see you again. Thanks for having us on.
Yeah, it's great,
Awesome
great to see you guys. Yeah, we're nearly there. We're so
close.
We're so close. I think we've got a lot more freedoms, Matt, than what Cam does. You guys have done pretty well up there. I think the biggest concern in Brisbane over the whole year was whether or not you could pack out a stadium for the NRL Grand Final, or whether it was going to get restricted because you had 2 cases. Who would have thought? Anyway, You seem to have done all right out of it. Cam's got more scar tissue than most because he's from that great state that is Melbourne, Victoria. Cam, how are you getting on, mate? You're getting ready to the starter pistol's about to be fired, and it's got to be flooding into the pubs, mate, and those rooftop bars that makes Melbourne in particular such a great place to have a beer.
Yeah, it's sort of like you're the last couple of metres of an egg and spoon race, mate, just trying to hang on to the egg before you stumble across the line. We're well and truly over it down here, gagging to get to the bar.
For you personally, Cam, the COVID experience for you, are you happy to have lived through it, or you wish you'd avoided it?
Last year, and look, terrible if anyone knows anyone, obviously, who's been hit financially hard or has lost anyone. So, but I haven't, my friends and families have done reasonably well out of it and have fared pretty well through it. Last year, I would have said, 1 year locked away with the family and getting to break out of the monotony of sports and all those sort of things with kids, it was a good thing, you know what I mean? Just to reset life. After 2 years, I'm going, no, get me back to normal life again. So I think we've come full circle and I've had an absolute gut full of it now. So just get me out.
Do you guys sit around a dinner table going, what's the first thing we're going to do when we're allowed out? You sort of got a favourite pizza restaurant you're going to hit or something?
Yeah, my wife's booked us now pretty much every minute up until Christmas, the second we get out of this thing. So we've got dinners, weekends away. I've got a new boat that's been sitting in the garage for a month and I've never had it in the water. So we've got a lot of stuff to get done.
Yeah, and how about for you, Matt? So it's just business as usual, isn't it? Up in the, what is it, the sun, what do they call Queensland again? It's beautiful one day, perfect the next, is it? Is that what it's
just the Sunshine State. I think
Sunshine State.
We'll just live with that one. I think Melbourne, Victoria used to be on the move. I don't know if you'd be saying that after the last 2 years. And actually they are. They're on the move to Queensland. So we'll see how that plays out. But it'll be interesting when we don't have COVID to talk about in every conversation we have with somebody. So we're going to work out how am I going to do an introduction to this podcast with you guys?
For those who don't know, Cam and Matt are regular guests on the Smart Property Investment Show. COVID's been the Kickstarter or the thing that's dominated or helped us frame property investment for the last nearing 2 years. Maybe we can have the next time we get together. Every time someone says COVID, they've got to give $1 to charity, I reckon.
Yeah, it's funny. It's about 2 months ago I noticed through the UK press that COVID wasn't making the top 10 stories, and I noticed today the Herald Sun. I think it's like page 9. So I think it's switched off over here. You watch it, it'll just fall out of favour really quick.
Yeah. Because you read some obscure stuff, Cam.
I was curious.
The Herald Sun.
Yeah, the UK press pouring over the pages. How many times? How many times does it mention?
Yeah, well, I was curious to see how focused they were on COVID when they were out of lockdown and trying to pair it up with how it's going to play out here.
You don't get the flu tally in a normal year, do you? So
no, that's
we'll see. I'm sure, as you said, I'm sure it'll just disappear from the media pretty shortly when it's no longer relevant and getting eyeballs on the news.
It's a funny point, the UK media, Cam. I don't know if you've ever looked at it with this particular lens, but you pick up the Herald Sun or, the equivalent here in Sydney and Brizzy or anywhere else in Australia. Yeah. Property dominates so much of the stuff that people read in the media. But in the UK, it's just, it's just not that visible. It's all about celebrities being idiots and football players misbehaving.
Yeah, correct. It's the players and the wags and nothing else really matters. And old mate's hairstyle. What is with his hairstyle? I don't get it. Is that a stylist thing? It must be.
That's how I look most mornings when I wake up. I try and groom myself when I'm catching up with you. Very important people when it comes to property. But this is a property show, gents, and we're here to chat about.
Let's get to it.
We're here to chat about the Victorian market. Let's kick this off, Matt. Yeah. And I think to help frame the discussion, I guess structurally, if you want to look at the Victorian market, you have metropolitan and rural or regional locations, number one, then you have houses and then you have units before we get to sort of like a suburb-based level or the factors around it. Can you give me some sense, mate, for the difference in performance around these different asset classes? Does it matter in this current market because everything is sort of going up? But more importantly, is it going to matter into the future?
Yeah, it's an interesting one. I know we talk about this a lot on your show, Phil. We're always talking about the fundamentals and obviously the three keys to the fundamentals of property that underpin the market: supply, demand, and affordability. So as they say, all ships float in a rising tide, and I think there's another saying, it's when the tide goes out that you see who's been swimming naked. I think that was one of Warren Buffett's sayings. So absolutely, almost every market in Australia has performed well in the last 12, 18 months, or particularly 12 months. And that's because we've been seeing property prices inflated by cheap money. Everyone's borrowing capacity has gone up. Interest rates obviously fallen to the floor, and we're at the absolute bottom of that interest rate cycle. So the most likely place for interest rates to go up in the future, or to go in the future, is up. Now, it's not expected to go up to 3% for the cash rate from where it's been at 0.1. But it's expected to go up over the next 2 years to, I think, a touch over 1% by a lot of the economists. Now, all that being said, that means that affordability is going to get a bit tighter unless wages go up to offset that in the coming years. So then I guess if we're thinking about fundamentals and we go, well, obviously the Melbourne market, the price has gone up, but is the fundamentals standard across every part of the market? So affordability, yes, interest rates have an impact on that, but so does the price of property. Obviously, there's some parts of Melbourne and Victoria that are more affordable than others. And it's not just having cheap price, it's also people in those areas need to have reasonable wages relative to the price. And then there's also markets where the supply of property is different. So it's not uniform across the city. I mean, we've seen in the last year, rents for apartments in the city, for some apartments, dropped by over 30% year on year. Now, they seem to have hit the floor and they're starting to crawl their way back up slowly as people have kind of realised it's a lot more affordable to move from an inner city location into a city apartment because they're going to get a 30% rent reduction, and that'll kind of make its way through some of those kind of higher density areas as well. But absolutely in the housing markets where we saw a rush to kind of space and it wasn't able to switch on supply as quickly as, I guess, perhaps you might expect. Obviously, the home builder boost has definitely increased the rate of land sales in some areas, but it hasn't delivered a heap of supply to the market yet. So I guess that plays into our outlook for Melbourne, those competing factors. And probably the last one in terms of fundamentals, demand. We've kind of always banked on high population growth for Victoria, and for the last 3 quarters, we've seen population in negative. In fact, there's, I think, about 40,000 people have moved to Queensland from Victoria in the last year. And yeah, obviously I can't necessarily see them moving back, but the big question mark is international borders. I think there was something coming out of the Business Council of Australia who have said that New South Wales should double the rate of immigration or in the next, pretty much for the next 5 years, to avoid a massive skill shortage in New South Wales, and also address a heap of other things where the infrastructure needs to be built and they don't have people. I'd expect there's probably going to be talk of that in Victoria as well, in which case that loss of 40,000 odd people who have moved into state, they very quickly get recovered when international borders open, if Australia is the beacon that we think it probably will be once we're welcoming people back in. So sorry, long story, went around in circles a little bit, but I think they're the key things for the market that anybody looking at where they might invest in Victoria has to be kind of considering those things, those competing issues.
And Melbourne was definitely ready. It was probably overdue for a market increase after probably for the last 4 years. We had APRA in 2017 put the brakes on lending and the market started to kick off again. And that was it kicked off hard end of 2019. And then obviously COVID kicked in and it just put it on hiatus for a couple of years. And obviously it fought against that. So the Melbourne market's been due for a steady growth increase. So I think it's going to continue on steadily for a period of time.
Yeah, and I guess the challenges you have is that New South Wales are getting out of the blocks pretty quickly, emerging out of COVID. Brizzy's always been situationally performing a lot better. However, its attitude toward COVID has been different. Whereas Melbourne's sort of stuck in a bit of a bizarro world. I really want to have a discussion around that. We'll just go to a quick break. Back in a moment.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Cam McClellan and Matt Lewison, directors at Open Corp, regular guests of the Smart Property Investment Show on the Property Investment Podcast Network. You can go and check us out, smartpropertyinvestment.com.au. Now, Cam, before the break, we're chatting about how some of the structural, functional factors which are going to enable New South Wales development, and there's going to be connectivity with that, with prices, and Brizzy, we'll cover that another topic at another point in time in another podcast. But I'm a bit concerned with Melbourne in that it sort of points a differentiation from other parts of Australia. I'm talking about Perth, Sydney and Melbourne. For attracting people, you've got this sort of flight to Brizzy. You spoke about 40-odd thousand people have moved from the state into a Brizzy. New South Wales is going to be attracting most of probably the early stage migrants in Australia as a result of COVID-19. Yes, Melbourne has good coffee. Yes, Melbourne has good sport. And then the demographers will tell you at a point in time it will become Australia's largest city. And I think that's probably about 20 years away by memory. But is that enough to actually empower the functional generational shift in terms of property price dynamics to move this market forward? Or do you think it's going to be left behind the other East Coast capitals?
Well, based on the data that Matt and his team look at when we're looking at the core of supply and demand, Melbourne's got a chronic undersupply of affordable housing at this point in time. Prices are pushing up. First home buyers are gagging to get into the market at this point in time, which is putting pressure on at the lower end of the market. Now, as we've talked about in the past, when you have first home buyers invigorating the market, you've got a bottom-up press on the market, which is a longer, more sustained growth cycle than when you've got just high-end prices pulling the market up. Melbourne's got its urban growth boundaries. It's got a set plan around building around activity centres, but the infill areas are becoming scarcer and scarcer to get hold of. If you want a house and land in Melbourne, it's quite difficult to get. Now, as investors, we don't look short-term. So if we look over the short term, I mean 3 to 5 years, we're quite confident that Melbourne will continually perform as it has been. Affordability's there. There's a drastic issue with supply in the market and the demand's still there. People haven't been able to get out and buy. We'll see the spring selling season kick in very soon. It'll be short and sharp pre-Christmas, and it's going to be a bit of a bloodbath, I think, for sellers and buyers out there. The activity, the things are coming on the market and they're going immediately before getting to auction now. And that's without coming out of lockdown. But then if we think long-term, as you said, as an investor, I'm thinking long-term, 5-10 years, and the immigration is set to turn on based on the fact that we've got this debt to GDP equation that the government needs to solve. The only way to solve that is to grow the economy, and hence they will be pouring immigrants into this country, skilled immigrants who pay tax, which is what we want, like never before. So I'll hang my hat on the fact that we'll see immigration at levels never seen in this country for decades to come to get the debt to GDP down. And those people love Melbourne. Do you know what I mean? While I love the other capital cities, Melbourne is, we've got the best coffee, mate. That's really what comes down to the fundamentals in the market.
Well, you only need to look at some of the numbers recently, and I think these are out of CoreLogic, 22.8% growth, annual growth. I think that's up to the end of September by memory for houses, 18.8 for units, which is pretty significant. You've had a number of key areas have cracked that $1 million median house price barrier, Geelong included. There's now, Cam, 173 suburbs with at least $1 million median house price. So something's going on. There is a demand for property in Melbourne.
And if we think the $1 million price point, I mean, years ago, and there's a lot of suburbs well above the $1 million mark, but I remember it's a decade or so ago when I was looking at the suburb I was in, and everyone who always wants to crack that $1 million mark. It's like when you're building a house and there's a magical date of December 25th, you need all the house building construction done by. People have got these magical dates, $1 million once you hit over that. But as an investor, I think it's more important to look at the factor of buying under the median house price and understanding how to get your property. If you think of it as an investor, your wealth is determined by the future valuation on your portfolio by bank panel valuers. So it's probably more important, rather than focusing on the $1 million number, is as an investor ensuring you're buying under the capital's median house price. Because if you think of the way valuers value your portfolio, they first go they look at RP data, price finder. The standard valuation is, the drive-by. They might do a walkthrough, or then they've got the desktop. So the drive-by and the desktop are probably the higher ones. So if you think of valuers, they are knocking out valuations pretty regularly. It's a bit of a sausage factory. So if you're trying to get valuation uplift on your portfolio, considering how valuers value when they look at the median house price, so they've got a 4-bedroom, they look at the capital city's median house price. If you're buying under the median house price, you've got more chance to get a favourable valuation. Alternately, if you're buying it, if the capital city's got $1 million median house price and you're buying an investment property at 1.2, the value is more likely to value the property down, making it harder to build your net wealth and equity, enabling you to duplicate. So the $1 million mark is good for headlines, Phil. There's no doubt about that. But really, as an investor, buying under the median house price is more important for that capital city.
And for you, Matt, does this all make sense from a sort of open corp perspective?
Oh, absolutely. When you look at the markets, and as I said earlier, prices have been going up pretty much unilaterally across the board in Victoria and around Australia. What we're looking for is what's going to happen in the future, because we want to be backing. If you're investing today, and you can't go back in time to invest and just chuck it anywhere. So you want to pick the suburbs or the places to invest that are going to give you the best chance of success in the future. And they're absolutely going to be the suburbs that are still affordable, because obviously when other suburbs become unaffordable, it pushes people into the more affordable suburbs. So it creates greater demand at that bottom end. And you can absolutely see it, because the southeastern suburbs, for instance, has been one of the most affordable markets. It's also a market that, while it had a lot of supply in the past, that supply is heavily constrained now. And it's no surprise that rents are up 9.5% in the last quarter alone for the southeastern suburbs. And the same when you look in the eastern suburbs, not quite as strong in that rental growth. But that's because there's as house prices are getting a little bit more unaffordable, rents kind of get dragged up because some people get stuck in the rental pool for longer. So we're seeing this playing out across the city in different regions, and it's a big contrast from one side of the city to the other. But absolutely, affordability is where you need to be focusing on if you're looking to invest, or that we would strongly encourage people to focus. Again, if you think about APRA's put the buffer up by 0.5% for interest rate serviceability. Let's say they go another 0.5%. That's going to diminish on average. I think people's borrowing capacity, my understanding is it's something like $30,000 for the average Australian. So but people at the top end of the market are well above the average. So their borrowing capacity is going to come down a lot further. So generally what we've seen when this has happened in the past is that the people who might have been able to afford the more premium suburbs kind of get pushed down either on price, or they go to the next suburb. That pushes people into the next cheapest and so on. And it creates that flow-on effect, but it actually increases the demand at the bottom end of the market as opposed to diminishing the demand at that more affordable end of the market. So yeah, if there's anything to take away from what we're saying today for any listeners, it would be to focus on where the market is affordable and where there's constrained supply and you're expecting that there's going to be continued demand. And the affordability itself can have a really strong impact on that demand.
Do you, Matt, not quite getting your interpretation of this, has the COVID lockdown largely had any impact on the property markets in Victoria? There's an argument to say that growth would have been accelerated for a period of manufactured sideways growth, and Cam mentioned sort of the APRA intervention back in 2017. So we're just really getting back to where the market should have been should that mechanical intervention not have happened. Is it irrelevant of COVID, or has COVID actually been a positive factor for driving prices in Melbourne?
Yeah, we absolutely we're moving into an upward cycle in the market. Now, I don't think, had all things been equal and COVID hadn't hit, I don't think we would have seen 22% growth in a year in capital prices. They would be the regulators would be managing that more closely. They're happy to see growth. It's great for obviously lowering gearing across the overall market, and steady growth helps to avoid people becoming over leveraged. But obviously with cheaper interest rates, that's had an inflationary effect. The other thing that we're seeing is all these constant lockdowns in Melbourne are holding up new supply. So while there has been a response from home builder of people wanting to go and take advantage of those opportunities, and even post that there's a bit of a land rush on where developers are out of stock and can't keep up. But it's also because people who buy a block of land can't get a house built in time. Often there's been delays in supply chains, as well as people being pushed, builders not being able to get their full teams to site. So it's taking longer to build. So until we start seeing house completions increasing, we're not going to obviously start to address that imbalance between demand and supply. So COVID has obviously exacerbated the situation in Melbourne in that regard as well. And probably the last part of it would be to say, and certainly in the CBD, there's an oversupply of apartments relative to, if you call it bums in seats, that when we went into the first lockdown, people fled the city. And certainly there was a lot of overseas students who would live in that, or people who might have just moved to Australia and they live in those high density apartments. And so the vacancy rate went through the roof. There was about 10,000 vacant properties in Melbourne CBD alone a little over a year ago. But there's also no new apartment construction happening, or it's anemic if there's any happening at the moment. And that, again, exacerbates that kind of potential medium-term supply imbalance, because we're not going to see any completions coming through for apartments in 12 months' time. At best, we're looking 2 years away. So if we see open borders and a rush of people moving into Melbourne, absorbing that existing vacant stock, which, to be honest, isn't that in terms of some of the areas that are oversupplied in terms of rental accommodation.
Oh, you think about
10,000.
Yeah, 10,000 vacant properties. Just open up one of the universities. That's one cohort of international students going to fill that in straight away. It's such a fine balance, isn't it, Cam, between, hey, we've got 10,000, how many thousand vacant properties? There's no one sort of living in these apartments right now. Let's not build any more. But, geez, you get some problems down the road.
Yeah, and it's similar when buying regional. There's been a lot of talk over the COVID period about buying regional, and some of the regional cities around Victoria have had some solid growth. Geelong in specifics, and I love my surf coast. I've got property down that way, holiday home down in Torquay. But then there's smaller cities which are still quite significant, your Bendigos and Ballarats, those sort of cities which people have been hearing a lot of noise about. The issue people need to be really careful of if buying in those cities is you don't have an urban growth boundary. So if you get an influx of 5% population growth, well, it's really easy for the local builders to knock out 10% additional building and construction, because the council will turn it on straight away and fill that demand. So people need to be careful about still buying regional at this point in time. Geelong's not bad. I don't mind Geelong. It's got the urban growth boundary and limited supply. But then you're talking before about the backlog of building and construction going on, which is causing pressure. Initially, there was supply issues with getting timber over and those sort of things. One of my good mates is the GM of one of the major building supply companies down here, Dalsons. And he said, we've got past that now. Containers are arriving, supply's there. He goes, we're still undersupplied, but it's not because of a lack of the amount of material coming over. We've got a housing boom going on here at that affordable end of the market. So that first home buyer, a real affordable end of the market, is really pushing hard, which is absorbing everything out of the market, and hence prices are pushing up from the bottom, which is making it harder and harder for people to get into the market.
But it's not that affordable either. In a lot of these markets that we might have like a year and a half ago considered affordable, you could get in maybe in the 500s to 600,000. Now you're lucky to get in for less than 700,000 in an affordable market as well. So
and it's funny. I feel sorry for first home buyers getting in. Even my kids feel recently I created a single trust for my 4 kids. And I've bought a block I put my name on a block which hasn't settled yet. And I've got plans done up, and I've made it a real thing with them. So basically going through the fundamentals of how to buy a specific property based on the growth, and looking at the data in there, and the kids looking at the house design and understanding that. So we've done it together, and we're ready to start construction in probably February by the time the block settles. But the reason I've done that is I'll control the trust. Their beneficiaries, they won't be able to afford a deposit in another 10 or 15 years. It's going to be really hard for people to get into the market. So my solution was, and I believe it's okay to give your kids enough to get started, just not enough. They don't have to do anything themselves. But I figured it's a lot smarter for me to make it an educational process, buy something in a trust now, let it double in value over 10 years, maybe duplicate it with a bit of equity, and sell the properties within that, pay the tax and split the money. And that's their deposit down the track, because it's going to be tough in another 10 years if people think it's tough now.
Well, that's the issue. And there's this number banded around now of like 6 times your earning capacity for what you can borrow. And whether that's right or wrong, it's largely a moot point. But we should get into that when it comes to investing in Victoria. We'll just go to another break, back in a moment.
Do you want to achieve wealth and passive income through property investing? PK Gupta helps a community of over 10,000 investors achieve passive income by buying top 5% growth and simultaneously positive cash flow property using data, without wasting months doing research, spending weekends at inspections, or dropping $15,000 on buyer's agents each time. So if you're overwhelmed with information overload but don't want to drop $15,000 on buyer's agents each time, check out PK's website, consultingbypk.com.au. and learn to build passive income through data.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Ken McClellan and Matt Lewison from OpenCorp. Now, 6 times your capacity for what you earn, make 100 grand, you borrow 600 grand. The issue you got in this environment is that we're already talking about 173 suburbs with $1 million median price in Melbourne. 100 grand salary is a pretty good salary. It's above the median salary for Australia. So there's a huge disconnect in this market. It can't keep, unless we get some significant wage growth, it's just going to be on this trajectory forever, and people, to your point before the break, Cameron, just going to get priced out, or they're not going to be able to get a start unless they've got, a smart old man that's sort of planning for 20 years ahead.
Yeah, it's the equation of the bank's calculators and what they enable you to do. People don't need to be conservative. It's okay to drag as much money as you can out of the banks because they've already got buffers in place. So some people get cautious about the amount of borrowings they've got. But you're right. I mean, 100 grand's a pretty decent wage. I think the average household might be 120. Don't quote me on that. I haven't checked the abs.gov for a while. So 100 grand's a fair bit, but that does get you into the market if you want to be an investor and get into the market. So people and affordability, on the other flip side, while rents aren't keeping pace with the growth of pricing as far as yield percentage goes, as we talked about before, interest rates are down. So it's offsetting that. And as interest rates start to climb, so will rents to offset the interest rate climb. So affordability tends to balance out. But people don't need to be cautious, I suppose, when they're looking at borrowing based on the banks have already factored in those buffers there.
Yeah, a good mortgage broker can help you understand all of that sort of stuff, Matt. So the question is, to that point, if you're looking to invest in the Melbourne market and this is a game of decades, not a game of months, property investment, should there be an expectation for capital growth moving forward and rents which can support positive cash flow, or is it going to be a up and down market moving ahead? How do you make those calls?
Yeah, certainly if you were to consider the likely trajectory of prices in the future, the odds would favour the capital growth. Now, that doesn't mean that it's going to be further capital growth at 22%. I think Westpac just came out with their updated forecasts from their chief economist, Bill Evans, and they're forecasting single-digit to high single-digit growth over the next year across Australia's house prices. I guess once you're looking beyond a year, then starts to kind of move into territory where you're making a lot of assumptions around population growth, wage growth, all sorts of things. But generally, I've always been a big believer that house prices go up a margin above inflation on average across a long term. And inflation's been low in the last kind of 20 years. And our property price growth is, despite what everyone might make you believe, has actually been lower than what it was the 20 years before that, where inflation was higher. So we're kind of moving into an environment where there's an expectation that inflation is going to be higher. So I guess it would stand to reason as well that you could expect that to flow through to wage growth, which will flow through to obviously better affordability in the future and give way to the next kind of cycle in house price growth again. So I think we're going to move out of this COVID-influenced house price cycle and back into a more normal cycle that's influenced by supply, demand and affordability again, kind of all those fundamentals that we've talked about a few times today. So I think that's positive. And as I said earlier, people just need to look at those, particularly markets that are, if they're oversupplied, that's probably a red flag, as it always would be. And don't just buy somewhere because you think every market's going to go up. You have to find the right market. And within a capital city, you have to find the right area that ticks those fundamental boxes. Don't just kind of rush into something without doing that homework.
And I guess we'll conclude with this particular chat, Cam. What do your numbers say in relation to investing in Melbourne on the basis of, if you've got one play to make and you're ready to buy today, should you be investing in Melbourne over other markets? And imagine it's a depends answer, but if you are buying in Melbourne or if you are buying in Victoria, but let's call it Melbourne, what sort of stuff should you be buying right now? And what's your recommendations around that?
All right. I'll answer it in two parts. I think Brisbane and Melbourne, I've never seen I've never seen Brisbane as tight as I have at this point in time in 20 years, but there's also areas in Melbourne. So like you said, it depends on, in my case, I've had, I just mentioned before, I purchased for my kids. I purchased in the southeast suburbs of Melbourne. So that must go to prove the fact that I do believe that there's some pretty good long-term growth in Melbourne as an investor when I've got the choice of any capital city and major regional towns. But yet I chose to put my kids and a lot of our clients into Melbourne. There's two factors around that. Brisbane I see as just as favourable, but I've got a very large portfolio in Brisbane already. So I had to balance it a little bit on my circumstance. But yeah, there's definitely areas in Melbourne that are so tight that there's going to be some nice growth for years to come, and hence the reason I'm still bullish about the Melbourne market.
And Matt, what sort of assets are most attractive in Melbourne at the moment? Is it house and land type stuff, established, new build? What's your play?
Yeah, so generally, and again, we come back to affordability. So there are, I think the markets, so I'll start there and then I'll come to the type of investments. The markets that I'd be focusing on are pretty much the east and the southeastern suburbs, where vacancy rates are below 2%. In the north, northwest, western suburbs, they're over 2%, in fact, over 3% in some parts. And also we're seeing obviously the CBD, like high density stuff, where vacancy rates are still up sky high at 5%, obviously down from 9%, so it's improved. I would steer clear of inner urban high density stuff, because even if it's outside the CBD, if it's an investment, you want to make sure you're going to get a tenant and you hope that your rents are going to go up. There's still a drag on rents in that area, but we're seeing on some of the middle ring to the outer suburbs where there is constrained supply, particularly east and southeast, that rents are on the way up. That tells us that there's going to be continuing demand into the next year or two and probably beyond. So what does that leave you with? That leaves you obviously with house and land. So new house and land with an established house, if it's fairly recent. And we're not advocates. I mean, there's people who can make great dollars out of doing renovations and putting their blood, sweat and tears into their homes. But we focus on, as I said, the fundamentals of picking the right market and picking the right area to invest in, the right house or the right property to invest in. So I can't drive around town and renovate everything. So we go for passive investments, but that's not to say that somebody who's got the skill and intent can't make money out of doing a renovation in some of these areas. But our focus would be house and land or newly built or even affordable townhouses. And there's a lot of townhouses that are small and not that affordable anymore. Like we're seeing 2-bedroom townhouses in the eastern suburbs of Melbourne selling for more, and this is the outer eastern, 30 k's from the city, selling for more than a 4-bedroom townhouse, 7 to 8 k's from Brisbane CBD. It's a huge disparity, and the rents on the one in Brisbane are 50% more than what you'll get for that one in the eastern suburbs of Melbourne. And again, that just tells you how tight the supply is for affordable stock in that eastern corridor and southeastern corridor of Melbourne. But if you can find an affordable townhouse, then I think that's a tick as well, because it'll continue to attract tenants and probably get a good yield for you in the future.
Matt's brother and I, Al, we built a portfolio, Phil might have mentioned, over the last 20 years of, I think it was about 26 res properties and a number of commercial properties. We started to divest that portfolio a couple of years ago, and we sold the last property out of that a week before last. Online auction, so no one could go to it. I was amazed, but that townhouse is a 2-bedroom in the far outer eastern suburbs in Croydon. We sold that for $690,000. Now, that shocked the hell out of me that we're pulling that sort of dollars for it. But yeah, and the reason we decided to divest that portfolio, while I'm an advocate of buy and hold, is that we decided that at some point down the track, having to hand over a portfolio of 20-odd properties to, my 4 kids and Al's 3 kids and let them battle it out, it's easy to divest it, pay the tax and split the money and put it into own portfolios. But to Matt's point, it's staggering some of the prices we were getting for a 15-year-old townie that we built way back when.
Happy days, mate. You must have a whole bunch of cash burning a hole in your pocket, mate.
It's terrible. It's terrible.
Investing. Terrible situation.
What's the old saying? There's only 2 problems with money. You either haven't got enough or you got too much.
Yeah. Well, both are good problems. I've been on Oh, I've never had too much money actually, but I've been where I've had none, and yes, it's I'd much rather not go there again. Anyway, gents.
Yeah, no, that's all right. It gives you time to spend with family, and
it does, mate.
The rest of it's just zeros on a page.
Yep, absolutely. So yeah, thanks, guys. I really enjoyed that. It was a bit of a deep dive into Victoria, and I guess the question for investors is, hey, where is your money best spent today? Is it Victoria? Is it Brizzy? Where are you as part of your investment journey, your investment life cycle? What's your level of diversification in terms of locations and also assets and price points and all this sort of stuff? You need to really get into it. Your account can help you, but probably these guys at Open Corp can as well. Cam, how can people sort of reach out to you guys and get in contact if they want to sort of pick your brains and understand what's going on?
Yeah, I'm happy to take, they can go to opencorp.com.au or they can flick me an email, cam@opencorp.com.au. Happy to field any questions. It's fine.
Matt?
And look, probably one of the other things that we're getting more and more at the moment because of that affordability question is a lot of people trying to work out how can they get into the market when they can't afford the $500,000 kind of entry point for a lot of properties. And obviously we've got Resi Fund as well, which is a fund we set up to help people get access to the Australian property market. It has a portfolio of investment properties and people can start in that for $1,000. So it's probably something else if they're just thinking, how do I start kind of gently and starting growing my deposit to get ready without the market running away from me. That's something else they can look at.
Has that got its own website, Matt?
Absolutely. resifund.com.au. And obviously it was set up to help people get access to that property market. As Cam said earlier, affordability is only going to get more and more out of reach for Australians. So I
agree. Well, go and check those out. Gents, thanks for your time and your insights today. I always enjoy catching up. That's Cam McClellan and Matt Lewison, directors, Open Corp, regular guests on the Smart Property Investment Show. Thanks for your time.
Cheers, Phil.
Awesome. Thanks, Phil.
Nice one. Hope you enjoy that, everyone. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ is where you can track us down. Plenty of other podcasts wherever you listen to this right now. One favour for me, please, can you keep those reviews coming on? I'm sure Matt and Cam are just about to pick up their phone and write how great a host I am and give me 5 stars. Anyway, but we do check them out and we do get a kick out of them. So if you do that for me, mate, that'll be great. Chat again soon. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.